Why was the Glass-Steagall Act eventually repealed? Imagine a world where banks could do everything from accepting your savings to trading stocks and insurance. That was the idea behind the Glass-Steagall Act when it was passed in 1933. It was created after the banking crises of the 1920s and early 1930s to protect depositors' money. The law separated commercial banking, which involves accepting deposits and making loans, from investment banking, which deals with securities and trading. This separation aimed to stop risky investments from putting depositors' funds in danger. Over time, the financial world changed a lot. By the 1970s and 80s, banks wanted to do more than what the law allowed. They argued that the restrictions made them less competitive compared to foreign banks and financial firms. Banks started lobbying to relax the rules, and courts and regulators began to agree. They issued rulings that allowed banks to get involved in some securities activities. This was a slow process of loosening the original restrictions. The biggest change came in 1999 with the Gramm-Leach-Bliley Act. This law officially repealed the main parts of the Glass-Steagall Act. It allowed banks to create large financial companies that combined commercial banking, investment banking, and insurance services all under one roof. The idea was that this would help U.S. banks compete better globally and give customers more options. But not everyone was happy with this change. Critics warned that letting banks grow bigger and mix different types of services could make them too big to fail. They feared that these large banks might take bigger risks without enough oversight. Some believe this repeal played a role in the financial crisis of 2007 to 2009. During that crisis, many big banks failed or needed government help, and some say the blending of banking types made the situation worse. Others argue that the crisis was caused by many factors, and that keeping the law might not have prevented it. In the end, the repeal happened because of years of pressure from the banking industry, changing markets, and the belief that integrated services would make banks more efficient and competitive. It marked a shift from strict separation to a more combined approach in banking history. This change has sparked ongoing debate about whether it made the financial system safer or more vulnerable.